Okay, welcome everyone to another exclusive Apt Wealth Partners event, our 2026 Outlook. I'm Andrew Dunbar, the CEO of Apt Wealth, and I just want to take this opportunity at the outset to thank all of our wonderful clients for your support this year. Myself, the investment team, and all our advisors looking forward to sharing 2026 with you, and we hope it's a successful one. Quick disclaimer before we start today. What's covered is not personal advice. It's general in nature and it should not be taken as a recommendation. Just some quick housekeeping. If you've got any questions, please use the Q&A box in your Zoom menu. You can put those questions in for any of our speakers at any time through today's presentation, and we've got some time at the end to get through as many of those questions as we can. We will be sending out a recording after the event, so any questions we can't get to, we'll be able to answer and send out with the recording. So there's plenty that's been happening in the world in 2025, hasn't there? And it's easy to get caught up in that noise. But the Apt investment team, they're working hard in the background to stay abreast of those developments to help you make the right long-term moves at the right time. And today we're going to hear from a couple of speakers. So firstly, Sarah Gonzales, Chief Investment Officer at Apt, and then Marco Colantonio, Executive Director and Portfolio Manager at Resolution Capital. And Sarah will briefly reflect on the markets this year and then look ahead to things to watch out for in 2026. And Marco will give some insight into global real estate and the opportunities that are ahead for investors. So without further ado, let me introduce Sarah Gonzales. She's well known to many Apt Wealth clients. As Chief Investment Officer, she provides portfolio construction solutions for advisors and their clients and manages the Apt Wealth Partners portfolios together with her team. Over to you, Sarah.
Thank you, Andrew, and welcome to all of our clients that have joined us this afternoon. As Andrew mentioned, today I'll be going through what has really happened over the last 12 months in investment markets, and then looking at the outlook and the factors that we're looking at for client portfolios. So just as a starting point in terms of what has actually happened over the last 12 months. So 2025 is really looking like it's going to shape up to be quite a positive year for all asset classes, as we can see in that graph there in the financial year to date 25. As you can see, most major asset classes on track to produce positive returns for 2025. And it will be the third consecutive year that all major asset classes have generated positive returns, which is, a great outcome for clients. But the journey obviously hasn't been as smooth as we would have hoped. As you can see in the graph below, equity markets really having a V-shaped recovery over 2025. The start of 2025 was quite volatile and just saw a sharp downturn, really driven by President Trump announcing a lot of the tariff plans that he had on Liberation Day back in April. But however, after Trump announced a pause on the tariffs, which was, only a few weeks after in April, we really saw equity markets rebound, recovering all they had lost by mid-May, and continue to rally on into 2025 with both the S&P 500 and the ASX 200 reaching all-time highs in September. In terms of what has really driven that recovery, it's a few factors. One of them being, obviously the tariff shock was much smaller than what President Trump had initially announced. A lot of the measures that he first announced saw tariffs reach levels that hasn't really been seen in over 100 years. So it was quite a shock. But obviously, as President Trump negotiated with his trading partners, a lot of those tariffs have come down. for some countries that didn't negotiate a deal, the tariff rates are still a little bit higher. But as we can see in the chart, the effective tariff rate in the US is now, much lower than where we saw in the April highs, really sitting at around that 10 to 20% range. So much lower than what was anticipated. And the next factor that contributed, obviously, to equity markets was the limited impact that tariffs have had on US inflation. I think there was a lot of concern that tariffs would lead to a spike in inflation. But as we can see in the graph, it's really been muted in terms of the inflation impact. As we can see in the US, core inflation is up slightly. But we are seeing some uplift in the core goods price inflation. So just something we're monitoring, particularly if the muted impact of tariffs of inflation is a little bit delayed. So just something we're monitoring as well. Another key factor that drove equity markets over the last 12 months has been central bank policy rates. So as we can see, with the exception of Japan, central banks globally have been cutting interest rates, in particular the US. We saw the Federal Reserve cut the federal funds rate by 0.25% back in September, and it was really the first interest rate cut by the US since December 2024. And that really, led to the strong momentum in equity markets, or contributed to the strong momentum. And what we've seen with the rise in equity markets is an increase in valuations compared to their historical averages. So as we can see in the graph, particularly Australia and the US, we can see that they are trading above their 20-year averages and near the top of the 20-year range. So valuations quite elevated, as opposed to if we see some of the other countries, particularly in Europe and emerging markets, they're trading above their 20-year averages, but at much lower valuations than Australia and the US. And I think the interesting part here is, particularly in the US, where a lot of the valuation uplift has actually been driven by earnings per share growth. So really strong earnings and fundamentals coming out of the US. However, in contrast, if we look at Australia, a lot of the uplift in valuation has actually been driven by multiple expansion. And we've actually experienced negative EPS growth in Australia. And if we look at the next graph, this is really shows where that is being driven by. If we look at the ASX 20, they're the big contributors in terms of that negative earnings per share growth, particularly in FY25. And what we're seeing is strong earnings per share growth in really that X20. So moving away from large cap Australian Aussie equities, we're seeing EPS growth coming out of that. And that's expected to continue into FY26. And what we've seen over the last 12 months as well, going off from the last slide, is the Small Ordinaries Index has had a really great year over the last 12 months, really closing that performance gap with the ASX 200 in regards to how we've been positioning clients over the last 12 months. It is, starting to increase that exposure to small caps well before this started to happen. But yeah, really seeing that Small Ordinaries starting to catch up with the ASX 200. And a big driver of small caps, I think it's no news to everyone, particularly happy here in New South Wales and Sydney. We've seen the news where people have been lining up out the door at the bullion, trying to buy gold. A lot of that rally in small caps has been due to precious metals, particularly gold. But we've actually seen strong momentum and growth in other precious metals, silver, platinum, palladium, really increasing over the last 12 months. I think they have a lot of uses in terms of particular platinum and palladium. They're used for electronics, solar panels, catalytic converters. I honestly didn't know what catalytic converters was, so I had to look it up. It's what the little system that reduces the emissions from basically petrol engines, which was interesting. So really, that's where a lot of the uptake is coming from, or the interest is coming from in palladium and platinum. But in terms of gold, a lot of investors have been really interested in gold, particularly as we are seeing central banks start to cut interest rates. We had volatility coming out of equity markets during the period. So that flight to safety really occurred during the last 12 months. And so, in terms of the next 12 months, what are the key things that we're looking out for our clients? I think the first part is in terms of global growth. Global growth is still going to remain resilient going into 2026, albeit I know some of the projections are showing that the global GDP growth will come down, as we can see in the graph there. So global GDP growth is expected to slow from 3.3% that we saw in 2024, and then down to 3.2 in 2025 and 2.9 in 2026. So a slowdown in GDP growth, but I think the key thing I would focus here is that the global economy is still growing, albeit at a slower rate. But we're not going into periods of negative GDP growth just yet. So economy is still growing. I think the big laggard in terms of GDP growth will be coming out of the US, where GDP growth is expected to fall quite sharply, 2.8% in 2024, then down to 1.8% in 2025, and then 1.5% in 2026, really being impacted by the high tariff rates, moderating net immigration, and the reduction in the federal government workforce over in the US. In the euro area, GDP growth is expected to slow down at a much slower rate, 1.2 to 1.0. So as we can see, euro area still having very slow economic growth, but still expected to grow over the next 12 months. And then as we see in Australia, GDP growth is actually expected to increase over the next 12 months. So 1.1% in 2024, then 1.8% in 2025, and then 2.2% in 2026, really driven by consumer spending and the increase in house prices. Next thing we're also monitoring and continue to monitor is inflation. I think there's still a lot of discussion in regards to inflation, given that it has been quite sticky in a lot of countries. So inflation in most G20 economies is projected to fall as economic growth and labor markets continue to soften. Headline inflation is expected to decline from 3.4% in 2025 and then 2.9% in 2026, while core inflation in advanced economies are expected just to remain stable at 2.6 to 2.5%. However, as I mentioned, it's something that we're monitoring. There are a lot of talks in regards to potentially inflation resurfacing. So just something we're continuing to monitor because it does impact how central banks react in regards to the continuation of cutting interest rates. And speaking about interest rates, also another area that we're looking at in regards to what central banks are really doing. And I think, this is a key one because it does drive a lot of investment markets because particularly the long-term bond yields are used as a valuation tool for a lot of assets. So in terms of the US, they are expected to continue to cut the federal funds rates into 2026, which is in line with the US Federal Reserve's assessment of downside risks to the US labor market have increased. So Fed expected to continue. In contrast, a lot of other major economies, as we can see in the graph, New Zealand, Canada, and even Australia, the rate of cutting is expected to slow down quite markedly, particularly in Australia. It is expected only one rate cut in 2026 of about 0.25%. That's still fully priced in, with a small probability of further rate cuts. Given that we have quite a resilient labour market, rising house prices, and the surprise inflation uptick in the September 2025 quarter, which has really changed or put a pause in the RBA's thinking in terms of further rate cuts. And then the opportunities or transition factors that we still see as playing an important role moving into 2025. Technology is still going to be a major thematic moving into 2025. Things like automation, machine learning, AI is expected to continue to drive investment opportunities. AI is really a multi-decade opportunity. There is a lot of talk around AI at the moment, but I think if we just look through what the ultimate impact of AI might be in terms of productivity gains, I think that will have a positive impact in terms of how business operates. There's different opportunities across AI, from semiconductors, cloud infrastructure, and data centers, which Marco will touch on a bit later. I think it's not just your NVIDIAs that are the key drivers of AI. I think looking broadly in terms of that AI thematic and what AI is touching in terms of other industries, that's a key factor that we're also looking at in terms of investment portfolios. An aging population, I think that's going to be a long-term one as well. The impact of the aging population will continue to impact, how people live, how they work, and even how they manage their money. So there's going to be opportunities that arise in regards to, how older adults live independently or where they live, which Marco will touch on in terms of those opportunities there, and also in regards to how they manage their money, which we've been seeing in terms of how we manage client portfolios and their strategies. The next one is the energy transition. I think this is a key one. Ignoring the net zero targets. I think in Australia, we have a lot of very old coal power plants. We're going to have to replace them at some point in time. It doesn't matter if it's alternative energy or, building a new coal or gas power plant. I think the outlook is for the use of alternative energies, because the cost of alternative energies is now so competitive compared to building, your traditional coal and gas power plants. So I think that infrastructure and energy generation spend is continuing to be a investment opportunity. So looking at that area, particularly in our infrastructure assets. And then the last one is geopolitical risk. I think this is now sort of a permanent factor in investment portfolios, unfortunately, well, particularly over the next 3 years now. And so, that's just something we're obviously monitoring. And now it's never been a time for diversification in client portfolios, which moves me into the next slide in terms of how we're positioning client portfolios. This hasn't changed since the last update, because I think a lot of the factors driving investment markets still remain in play. But as I went through in today's presentation, different economies, different countries moving at different rates, and different factors impacting each country. So I think it's really important, that we diversify, particularly across asset classes and geographic regions, really to capture different opportunities and capture different returns at different times. So in terms of that, sticking to the long-term plan, that's really our focus for our clients. They're sticking to their long-term goals, making sure that we have the strategy in place to make sure you continue to meet your long-term objectives. taking advantage of opportunities. As I mentioned, I think volatility is going to be a mainstay in investment markets. And so taking advantage of those investment opportunities. And as I went through in the last slide, there are opportunities out there, which leads me perfectly into Marco's presentation, which he'll go through the opportunities that he's seeing in global real estate.
Fantastic. Thanks, Sarah. Yeah, it seems like there's going to be a lot of change again in 2026 and non-stop headlines every day. And I think, as you've said, we've got to look through that noise, focus on fundamentals, focus on what we can control. So thank you and your team for all of your work. All right, we will welcome Marco Colantonio from Resolution Capital now. They are one of Apt's key investment partners. And Marco is one of the founding members of Resolution Capital with over 30 years' experience in global financial and property markets. And Marco is going to highlight why the Resolution team see value in global real estate investment trusts and some interesting emerging growth areas, as Sarah said, such as data centres and seniors housing. So over to you, Marco.
Excellent. Good morning. Thank you, Andrew, and thanks everyone. Thanks for the opportunity to present today. For those of you who aren't overly familiar with Resolution Capital, we are a global listed real assets investment manager, a long history of investing in global listed real estate. So we really started investing in Australian REITs 30 years ago, and we launched our global REIT strategy 18 years ago, just before the global financial crisis, which was very fortuitous for us. And about 4 years ago, we launched a global listed infrastructure strategy as well, making out the real assets house that we are today. So my presentation today is going to focus on real estate and global real estate. And to be frank, it's been a pretty challenging period for commercial real estate over the last couple of years. Part of that has been related to rising interest rates, but also, of course, over the last couple of years, investor attention has been drawn towards more exciting, more interesting areas like AI, technology, crypto, and as Sarah was mentioning, gold more recently, etc. And to some extent, and echoes perhaps to the late 1990s, is real estate seen as a bit of old world, an asset class that you don't really need to be invested in right now because there's a lot more exciting things to do. But what that misses, and what I think the market is underappreciating, is highlighted on the slide that we've got up right now. And it's why we're very constructive on the outlook for commercial real estate going forward. And that is, anyone who's renovated a house or done any sort of construction work over the last couple of years would know that construction costs, and we think about it as real estate replacement costs, have increased very substantially since 2019. And this is a global phenomenon. And we're seeing somewhere in the range of 25 to 40% increases in total replacement cost of commercial real estate since 2019, which is highlighted in the red line that you can see on this chart. And that's contrasted with what commercial real estate values have done. And since their peak in late 2021, commercial real estate values are down somewhere in the orders of 10 to 20% for the reasons I outlined a moment ago. And so we're now in this quite rare position where, once again, commercial real estate values are below replacement cost. Now, what does that mean? Well, first of all, it somewhat puts a floor under real estate values because they're trading below replacement cost, and they can't fall too far below replacement cost as long as there is some utility there. But more importantly, it basically means that developers are not incentivized to start new developments on a speculative basis unless rents increase quite substantially. And so if you match a limited amount of new supply combined with a reasonable amount of tenant demand, then you can potentially see very significant rent spikes, and we're beginning to see evidence of significant rent spikes in some commercial real estate markets where there is strong tenant demand matched by limited new supply. So I'm going to highlight a few examples today of where we're seeing this dynamic and where we're beginning to see good rental tension. Now, one area of the market that people have not really focused on for quite a period of time has been the retail market, shopping centres. And a lot of that's been because really, and if you can see on this slide, what we show is two segments of the real estate market and the historic levels of construction starts. This is data going back 50 years to 1970. And you can see that on the left-hand side, retail construction starts up until about 2007 typically averaged around about 2% per annum of existing stock. Every year, developers would start about 2% or add to supply about 2% of inventory. But that came to a screeching halt in 2008 when we had the global financial crisis. Obviously, in a deep recession, there wasn't a lot of incentive for developers to continue to start new property developments in the retail space. And so construction starts fell to around about 1% of inventory. And then it kind of started to rise a little bit, but then we had the rise and further rise of e-commerce and the likes of Amazon. And therefore, developers were no longer incentivized to build a whole lot more retail space as they were historically. And that kept a lid on construction. Then we get to the point where we have the global pandemic. And again, retail was shut down for periods of time. Nobody thought we were ever going to shop in a physical shopping center again. And why would you develop more shopping centers? So we come out of lockdowns, people returning back to the stores, but now developers are faced with that dynamic I highlighted in the previous slide of rising construction costs, rising interest rates, and uncertainty about commercial real estate values. And so the developers continue to stay away from returning to that level of historic amounts of construction starts. So you string all those three things together, and you've had now 18 years of very low construction activity in retail. This is major retail shopping centers. Now, if we contrast that to industrial, which is highlighted on the right-hand side of this slide, and you can see that in 2008, same thing happened. Supply did come to a screeching halt, but it then built back up and very significantly with the same dynamics that we saw in retail, the rise of e-commerce, the rise of Amazon. They needed more warehouse space. And developers responded and they developed more space. And that got supercharged during the global pandemic because everybody thought that we're going to only be buying from online and from warehouses. And we also had supply chain bottlenecks occurring around the world. And so there was just in case inventory management rather than just in time inventory management that had been the narrative prior to the pandemic. And so developers continued to develop all the way up to the point where it got to 7% of inventory being added to new supply. Now, that's also come down very significantly in the last 2 years because of the dynamic of rising construction costs and rising replacement costs, making it more difficult for developers to justify new development unless they see increasing rents. And so we have seen that come down, albeit only down to the long-term average level. So we're quite I guess still conservative on the industrial positioning because that we've had this large spike in supply and there's a little bit of indigestion going on now in terms of absorbing all that new supply. Whereas in retail, we've had no supply for 18 years. Occupancy levels are at record highs in most good quality shopping malls and rents are increasing. And so for us, this highlights the dynamic that we're seeing is limited new supply is providing opportunities for landlords to push rents. Now, it's pleasing also to see that occupancy levels have held up pretty well for most segments of the commercial real estate market. The obvious outlier is office. office, and this is US office occupancy rates in US listed real estate companies or REITs. And office is the outlier, obviously because of work from home and the structural challenges facing office. To put it in perspective, office is about 5% of our global portfolio. So it's fairly minimal, but most other sectors are seeing relatively solid occupancy gains and maintained above long-term averages. And that's because there's been relatively limited amounts of supply in most of these sectors. And in fact, retail has been one of the best performing occupancy recovery stories. But we see consistent levels of stable occupancy in our portfolio over the last 10 years. So despite the negative headlines about commercial real estate being under pressure, we're seeing pretty good occupancy levels and very low levels of supply. Now, one other area of the market that I wanted to touch on where we are seeing this limited amount of supply, but yet very strong demand, and it's an area that Sarah mentioned in her thematics, was the aging population. And that is, in real estate terms, positively impacting the seniors housing market. And this is a demonstration of the US dynamics impacting the seniors housing market. On the left-hand side of this slide, you can see the rising population growth rate for the over 80s age cohort. It's projected to grow by almost 5% per annum over the next 15 years. So a doubling in the number of people who are over the age of 80. And yet the quantity of deliveries, the quantity of new supply of seniors housing units has fallen to a cyclical low. Now, why is that? Well, again, more recently, it's been rising replacement costs and rising construction costs that have kept developers away. But prior to that, the initial reason why developers were scared off was because of the initial impact of the pandemic, which negatively impacted this age cohort. But eventually we will see a supply response, but supply takes time. You've got to get your planning approvals. You've got to get your financing. Banks are less willing to lend to this segment of the market than they were previously. Many of the seniors housing facilities were previously financed by small and medium-sized banks who've all kind of pulled back from lending to developers in this space post the pandemic and post the Silicon Valley Bank crisis of 2023. And so what we're seeing is very strong supply and demand fundamentals in the seniors housing segment of the real estate market because of this rising aging population driving demand with limited amounts of new supply. And another thematic that Sarah touched on was technology and the rise of AI. And again, we have opportunities to express this in our portfolio via an exposure to data centers. And data centers are obviously seeing the benefit of increased levels of CapEx from the major hyperscalers. And that's been driving increased rents for data centers. Now, it's important to point out here that there's a few skeptics about the outlook for data centers, and logically, there's good concerns about the potential for oversupply of data centers. And we agree that there is a lot of capital chasing exposure and developing data centers. But it's important to understand where most of that new construction activity is being focused on. And for the most part, by necessity, it's been focused in what we affectionately call the cornfields of the US. It's in the middle of the country. It's in places like Louisiana and Kansas, Abilene, Texas, markets that have got large vacant land lots. And nominally, there is, historically been fairly cheap electricity because it does need a lot of electricity. And, historically, these states have got fairly low priced electricity, albeit not always immediately available. So there's long lead times to actually get the power and the infrastructure, the grid lines to the sites. But nonetheless, most of this supply is being directed to the cornfields. Where the listed real estate market or real estate players have their exposure to data centers and where our exposure is predominantly in major metropolitan markets where it's much harder to bring on new supply. And there is also a multitude of different use cases for these data centers in these major metro areas. What you would have heard a lot about is the new mega AI factories being developed in those cornfields, mainly focused on the AI training phase. Now, this is where the AI models are learning everything that they need to learn. And the next phase of AI is when we all begin using AI, and that's termed AI inferencing. And generally, the view is that AI inferencing is going to be need to occur closer to where the end users are because it's lower latency. It's more latency sensitive. If it's helping a robot, conduct surgery, then that couple of milliseconds of latency that it takes to get from the cornfield and back can mean a very big difference to how that robot may be operating. Or if it's an autonomous vehicle or the multitude of other use cases for AI, it's important to have low latency and well-connected networked data centers. And that's exactly what the listed REITs do. They have locations close to the end user and with great infrastructure in terms of connectivity to the major networks. And so we see a good runway for a multitude of different uses, not just AI inferencing, but also traditional cloud usage that will continue to drive demand for data centers in these locations, even if AI doesn't turn out to be as great as people have initially thought. So our portfolio positioning is matching areas of the market where we see limited amounts of supply and yet where secular demand growth is occurring. So that's retail, it's healthcare, it's data centers. There's also self-storage and there's residential. These are markets where we see good rental growth based on needs-based tenant demand matched with limited amounts of new supply. And whenever you match limited supply with increasing demand, you typically get landlord pricing power, you get higher rents, and therefore REITs have the opportunity to drive earnings growth positively. And that's the outlook that we have for the global listed REIT market after a couple of years of ups and downs, obviously impacted by the global pandemic in 2020. We did see a bit of a rebound in earnings per share for the global listed REIT market as it caught up and tenants began paying rent again. Then we had a bit of an adjustment as interest rates increased, but now we see a steady path for continued growth in earnings per share. And it's important to point out that global listed real estate balance sheets are in very good shape. Leverage is modest at about 5 times debt to EBITDA. That equates to around about 35% loan to value ratio. So these are not highly levered real estate plays. They have very well diversified debt sources of capital. Part of the problems that occurred in the lead up to and during the global financial crisis are not evident. Some of those problems at the time, some of the listed REITs, some of you might be familiar with Centro, they had a major credit event. They had most of their debt maturing on one particular day. And that day, unfortunately, the credit markets were disrupted. And so they fell into hard times. The REITs have learned the lessons of those troubled times. They've laddered their maturities profile so that over the next several years, not more than 10% of debt becomes that matures in each of the next 4 years. So it's well laddered debt maturity profiles from a broad range of different borrowers. They are mostly investment grade rated, have access to the corporate bond market, and are in no means desperate to raise equity or are forced sellers of assets on the whole. So we see the balance sheets in very good shape. And yet, as I mentioned earlier, real estate has been a little bit unloved, particularly relative to global equities. And this is just one measure of valuation returns or valuations of the two asset classes. And so, the red line being global equities has had a spike in valuations, as Sarah was mentioning, whereas REITs, the gap has really opened up in terms of the PE multiple. And another way to look at, another valuation metric that we look at is REITs premium and discount to private market values, or NAVs as they're often termed. And again, we see here REITs trading at a discount, not a dramatic discount when we look at the global universe, around about that sort of 5 to 7% range. But we are seeing signs of deep value in some particular markets. One of those markets is the UK and Europe, as you can see here, where we're seeing around about 30% discount to appraisal values, to private market values. And that's despite what we see is continued good balance sheets and good operating fundamentals in the UK. And so one of the examples that we're seeing here is in the UK as an opportunity is Big Yellow. Now, Big Yellow is the #1 self-storage franchise in the UK. 70% of its portfolio is focused on London and the Southeast. It's a £3 billion portfolio. It's a founder-led business. Most of the self-storage facilities that they own today have been developed in-house, and historically has grown its earnings by about 8% per annum. And we think over the next couple of years should be able to return to that 8% per annum earnings per share growth as they develop more self-storage facilities. Now, importantly, again, you'll hear me often repeat that we're very focused on the supply side of things. And when we look at UK self-storage, the self-storage market in the UK, it is a relatively supply-constrained market, as you can see on the bottom right of this slide. In the UK, there is less than 1 square foot per person of self-storage space. That compares to just over 2 square feet per person here in Australia and 9 square feet per person in the US. So the UK is a supply-constrained market. And as a result of that, Big Yellow and other UK self-storage REITs have actually been achieving relatively stable rent growth and really good operating conditions. Yet macro concerns about the UK economy, and we're about to see tonight what transpires with the latest UK budget. There's a lot of trepidation about that, but it's caused a lot of concern about the UK macro environment, and investors have really been disinterested in investing in UK domestic businesses, and this is obviously UK domestic focused business. So as a result of that, you see the valuation being very attractive. This is a almost 7% property yield. The valuers will tell you that they think it's worth about a 5% yield, but this is trading 200 basis points above what the valuers think the real estate should be valued at. And mind you, the valuers are only tasked with the job of assessing the real estate value, not the brand value of Big Yellow, which is the #1 leading brand. And so as a result of that, Big Yellow trades at about a 30% discount to net asset value. That equates to about 22% discount to gross asset value, about a 16 times PE multiple, and a 5% dividend yield. With a good balance sheet, loan to value ratio is only 14%. And to us, we see this as a great franchise trading at a deep discount, and we were frustrated that the stock continued to underperform because of macro concerns about the UK economy. Pleasingly, in early October, Blackstone came out with an announcement saying that they were considering making a cash takeover bid for Big Yellow. Now, they haven't actually put any price on the table yet, and they said that they're waiting for the budget, so we'll be waiting to see what happens over the next couple of weeks. But Blackstone is a very well-capitalized and sophisticated investor that tends to often lead what other investors think and do. And so it's very pleasing to see Blackstone indicate interest in a company like this, which is the largest exposure we have to the UK market. And it is a signal that perhaps M&A activity will again return to the REIT market, because it has been a market that has been sort of left by the wayside. Investors have been interested in other segments of the investment universe, and yet the operating fundamentals are actually quite sound. Now, I'm going to quickly highlight a couple of other stocks that are in our portfolio. Welltower is the largest exposure in our portfolio at the moment, and it has exposure to that seniors housing, aging population demographic that I mentioned earlier. 84% of its portfolio is exposed to seniors housing, and in that segment of the market of their business, they're growing net operating income by 20% per annum. Very significant growth. And this is as a combination of rising occupancy and rising rents and reducing costs that did blow out during the pandemic, but are now normalizing again. It has a very strong balance sheet. Loan to value ratio would be in the mid double digit 15% range. And we think that its earnings growth is going to be tracking at around about 15% per annum over the next 5 years. That's very strong for a real estate company. Another company that we see a good trajectory for earnings growth going forward is exposed to the data center thematic and AI thematic, and that's Digital Realty. After a couple of years of bumpy earnings growth per share, as they right-sized their balance sheet and as they worked through some legacy leases, they're now on a trajectory to grow earnings by about 8% per annum. And they do have a very good pipeline of developments that they're doing both on their own balance sheet and in joint venture with other parties. Merlin's an interesting stock. It's based in Spain. Historically, it was a diversified Spanish portfolio of office, retail, and industrial. But they were early on into the pivot into data centers. And so they're converting some of their industrial facilities into data centers. And this is somewhat similar to what we're hearing about for a multitude of different industrial landlords. And many of you would probably be familiar with the local example here in Australia, Goodman Group. They are successfully converting some of their industrial facilities into data centers. But the key point of difference between Goodman and Merlin is valuation. Goodman trades on close to a 30 times earnings multiple. That's a very good company. It's got a very good balance sheet. We like what they're doing, but it's very expensive. Merlin, on the other hand, is also pivoting towards data centers, as I mentioned, yet it trades at closer to a 20 times earnings, and that's a very clean earnings number. They don't capitalize interest, they don't capitalize overheads, and they expense all of their incentives. So we think that it's a good way to play that data center conversion thematic as well. And we think it's a much more interesting valuation relative to the local example being Goodman Group. So to summarize, we're very constructive on the outlook for global listed commercial real estate, principally because we see that commercial real estate values are trading below replacement cost, and that's going to limit the amount of supply. Now, listed real estate segments are focused on needs-based real estate. As we mentioned, rising demand for seniors housing, rising demand for technology-related stocks, but also, residential, retail, and self-storage, increasing use and increasing demand with limited amounts of supply, which leads to conditions where we think we can see particularly strong rent growth going forward. Balance sheets are in good shape. And, Sarah mentioned as well, valuations in many other parts of the equities market are elevated. But as I tried to demonstrate, real estate values have sort of been left by the wayside. So we think the valuations are very attractive. We're seeing increased levels of M&A activity. And therefore, we think that listed real estate is a very good place to have some diversity in your portfolio where operating fundamentals are very sound. And importantly, it offers exposure to good quality real estate. And because it's listed, it's liquid. So we have never frozen redemptions from any of our real estate funds. And if some of you have been invested in unlisted property funds, you may have experienced redemption freezes. But we are completely liquid, and you have access to your money if you need it. So with that, I'll pause, and I think we'll open up for Q&A.
Fantastic. Thanks, Marco. That's a fascinating and sensible presentation that you've given us. And I'll tell you what, you talked about rising construction costs for commercial real estate. If anyone on this call's done any work on their house in the residential space, let me tell you, it's not just commercial costs that are rising, the residential's out of control as well.
Absolutely.
Yeah, thanks, Marco. That's great. So, I think it just highlights the expertise that we've got in the investment team that we've got access to. And that was a really well thought out presentation. So thanks, Marco.
Thank you.
Yeah, we've got a few minutes to answer some questions. We've got some questions coming through. Just a reminder, if you've got a question, put it in the Q&A box in the Zoom menu. Let's start off, Marco. There's a question here. How sensitive are global REITs to interest rates, and what do you expect would be the performance if rates stayed around where they are at the moment?
Yeah. So look, it's fair to say that global REITs are sensitive to interest rates. I think that's one of the reasons why commercial real estate values did come under pressure over the last 3 odd years. But I'd say that interest rates are important for all asset classes, or at least it should be. And we take the view that it's important to understand why interest rates might be changing. And you'll notice that in my presentation, when I talked about how constructive we are about the outlook for commercial real estate, I did not base that on the fact that perhaps interest rates might fall. In fact, one of the things that has occurred is interest rates have risen, and that's been a hurdle for developers, and that's limited supply. So to some extent, having higher interest rates, or what we think of as really, normal interest rates, because we all got used to very low and in some countries negative interest rates, which is just, ridiculous.
Mm.
We got used to very, very low interest rates. We think we're returning back to a more normal interest rate environment, and it's actually good for capital to have some level of discipline imposed upon it so that you don't have willy-nilly speculation going on in real estate markets or in other markets for that matter as well. And it's important to point out that, as I mentioned, why interest rates might be falling. So, I think Sarah had earlier on a chart showing interest rates movements, or central bank movements in interest rates, all the way back to and including 2008, when you saw central banks cutting rates very aggressively. And yet real estate performed terribly during the 2008 global financial crisis because many of them were over-levered, and we had a very deep recession as well. And so they were cutting rates because they needed to. And so, it's important to understand why interest rates were being cut. It's because we had a major recession, and that was crimping tenant demand, and we had too much speculative supply going on, and there was also a whole bunch of irrational things that REITs were doing back then, which they're not doing anymore. Balance sheets are in great shape. They don't have an over-reliance on development and funds management income streams. And so the operating fundamentals and the earnings base that we see today is much more solid. The balance sheets are very strong. And so even if we don't see interest rates falling, we think that the setup for commercial real estate is actually quite positive. And another example that I think was interesting that was highlighted by Sarah's slide is that one of the markets where we have seen recent increases in interest rates, albeit very delayed, has been Japan. And finally, the BOJ has been increasing rates after nearly 40 years of deflation or very low inflation in Japan. They're finally seeing a little bit of inflation, and so they're raising interest rates. Well, guess what's been one of the strongest real estate markets globally over the last 12 to 24 months? It's been Japan, despite rising interest rates. Why is that so? Well, because inflation's been so low for 40 years, rents have been flat or down for most of that last 30 or 40 years. Now, finally, they're beginning to see inflation. They're beginning to see improving economic growth, and landlords are beginning to, pass on that inflation through rents for the first time in a long, long time. And interest rates are still relatively low in Japan, and so they're still able to positively gear real estate opportunities in Japan. And it's been a very positive move for that particular area of the market. So that's why we say it's really important to understand why interest rates might be moving in one direction or the other. It's very important to understand what the supply and demand fundamentals are and the balance sheets are of the companies that we're investing in, because it actually could be a positive.
Yeah, that makes sense. That's great. Thanks, Marco. Now, there's a couple of questions here around AI. We talked a little bit about AI. Sarah, I guess the crux of these questions is really asking, is AI a bubble or is it real?
Yeah, look, it's an interesting topic at the moment, and I think it's been talked about for months now. And as I mentioned during my presentation, we're certainly seeing, valuations for particular companies at quite elevated levels. But I think it's important to, as I mentioned, we're seeing a lot of earnings per share growth in the US. We're seeing a lot of earnings per share growth in a lot of, your more traditional AI companies that we think about, like Nvidia or your Microsoft. So we are still seeing earnings per share growth over the next few years. But I think, as I also mentioned during the presentation, I think the important thing in terms of AI is looking beyond, the certain few companies and looking beyond the applications of AI. I think in terms of, I think there is definitely a lot of hype around AI, whether it is, around data centers or semiconductors. But looking through it and finding peripheral sort of holdings where valuations aren't as expensive, I think you can still find pockets of companies that aren't significantly overvalued. And I think at the end of the day, I think over the long term, as I mentioned, AI is going to be a multi-decade thematic that is just going to transform the way businesses operate. Whether it's a low utilization of AI to very high utilization of AI. I think AI will have some impact on how businesses operate, just like the internet did. But obviously, the impact on productivity is expected to be quite positive. So I think, while at the moment some particular companies are quite elevated and the outlook for usage, for example, of data centers, might be elevated at the moment. I think at the end of the day, businesses, we're still going to need these data centers, even if that demand projection isn't as high as is what it's expected to be. I think there's still going to be demand for it because I think the increasing use of AI will just continue.
Yeah, great. Yeah, so AI is here to stay. Whether the hundreds of billions of dollars a year being spent by the headline names proves to be a good investment or not, maybe that's a question. But as both of you have said, there's a lot of opportunities in the market at the next level down. Great. We've probably got time for one more question. So, Marco, maybe I'll throw this one to you. It was a great case study that you presented on Big Yellow in the UK. And we talked a bit about the noise and headlines that are around. And there are headlines that the UK is struggling with economic growth and, it's all bad news over there. So what are the factors that make you go and invest in the UK in that scenario?
Yeah, we often joke that during tough times they have to print a lot more newsprint over in the UK because the papers just have to write so many stories about how bad things are. So they really can get very, very glum over there. And look, to be fair, they do have some challenges. The economy is certainly, I think, been negatively impacted from Brexit. Inflation's been a little sticky, and therefore interest rates have stayed, a little high. Long-term interest rates have stayed a bit higher than in some other markets. And it feels like the UK government is, bumbled their way through and, from one disaster to the other. Ironically, it was widely hoped that they might actually increase income taxes a little bit to address the fiscal concerns, and that would have been a benefit for the bond market. It doesn't sound like it sounds like they've backed away from that in recent weeks, and so we'll see tonight whether that what transpires there. But look, as I said, what we're seeing on the ground, albeit that there's some macro concerns, but on the ground, most of the commercial real estate markets are seeing low vacancy rates. When we look at office markets, for example, around the world, we can compare, say, San Francisco, Seattle, and many of the US markets, which have vacancy rates in the office segment, approaching 30%. We compare that to the London office market, and in the city, vacancy rates are around about 7%. That's lower than what we have here in Sydney. And underlying market rent growth in London has been growing at roughly 5% per annum for the last couple of years. And so, there is definitely some concerns about the, investors' appetite to increasingly buy commercial real estate in the UK with these macro uncertainties. But if you look at what's going on at the tenant level, at the base level, we're seeing, very solid operating fundamentals. We're seeing it in retail, where the likes of Land Securities and even Unibail-Rodamco, which owns the former Westfield assets in the UK, they're seeing record high occupancy levels, and rents have significantly reset from elevated levels, and values have reset very significantly, and yet the stocks trade at 30% discounts to those reset values. So we think it's discount to a discount. The balance sheets are in good shape, and so unfortunately it requires a bit of patience. We think ultimately these macro issues will resolve themselves, and we have around about 9% exposure to the UK in our portfolio at the moment. So that is an overweight position relative to the benchmark, but it's certainly not an overwhelming exposure to have in a diversified portfolio. And as I said, we just see very good operating fundamentals. So we continue to monitor the macro conditions and the relative valuations.
Yeah, again, makes total sense. So thanks very much, Marco. All right, well, I think that's all we've got time for today. So big thank you to Sarah and to Marco for giving up their time today. And thank you again to all of our clients for your support in 2025. Hope that's been useful. If you've got any more questions, you can take those questions straight through to your advisor. Any unanswered questions, we'll endeavour to get those answered when we send the recording out. Keep an eye out for more events coming your way, and we look forward to catching up soon. Thanks, everyone.
Thank you.